Hello, in this video, we're focusing on the practical concepts that you can actually apply in the real business world. Hope you enjoy it. Let's get on with it. When deciding whether buying a franchise is a true investment or just a job, it often depends on how the franchise is structured, the role the owner takes on, and their goals in making the purchase. Franchises can offer a safer path than starting a business from scratch, because they come with a proven brand, established systems, and ongoing support. However, some see franchising as simply paying for a job with limited independence and growth potential. At its core, a franchise is a licensing agreement where the franchisor lets the franchisee run a business using their brand and know-how in exchange for fees like an upfront franchise fee, ongoing royalties, and sometimes marketing or technology fees. In return, franchisees gain access to a recognized brand and standard processes. This balance means a franchise can be either an investment asset or a form of self-employment, and understanding this distinction helps buyers know what to expect and make smarter decisions about using franchising as a way to grow their business or build wealth. Franchise businesses often provide training, ongoing support, and access to supply chains and marketing systems, which can make them attractive. However, this setup can blur the line between being a business owner and an employee, leading to questions about whether buying a franchise is truly an investment or more like taking on a job. When a franchise depends heavily on the owner's daily involvement, such as working full-time, managing staff, serving customers, or covering shifts to maintain profit margins, it tends to be just a job. In these cases, if the owner stops showing up, the income usually drops significantly, indicating that the business can't run profitably without their presence. Another important point is that franchisees often have limited control over key aspects like pricing, suppliers, marketing, what products or services they can offer, and even operating hours. While this reduces risk, it also limits the ability to make strategic decisions and grow the business independently, as those decisions are typically made by the franchisor. This means the franchisee's potential for entrepreneurship is constrained, reinforcing the idea that some franchises function more like jobs than investments. For many people looking for creative freedom or the chance to grow a business, owning a franchise can sometimes feel more like being an employee with money on the line rather than a true business owner. Most franchises offer steady but limited earnings, with profits often restricted by royalties and required costs, and they tend to have little resale value unless you own multiple locations. For example, a single franchise unit might bring in an annual income between £40,000 and £70,000, enough for a stable lifestyle, but rarely enough to build substantial wealth. In these cases, running a franchise can feel like having a salaried job, but with longer hours and personal financial risk. On the other hand, a franchise ceases to be just a job when it operates as a well-defined system, rather than depending on the owner's daily involvement. This means having delegated management, clear operational manuals, measurable performance metrics, and repeatable financial models. At this point, the owner's role shifts from frontline operator to someone who allocates capital and manages managers. A good sign that you truly own an asset is when the business can continue to run profitably without your direct involvement for extended periods. Successful franchise investors usually own more than one unit because multi-unit ownership offers several advantages. It helps spread fixed costs, creates management leverage, and gives more bargaining power with franchisors. It can also improve the value when you eventually sell. For example, one fast food outlet may generate only modest returns, but only 5 to 10 locations can provide a level of cash flow and overall business value comparable to a professional investment. At this point, the franchise operates more like a portfolio investment, where systems manage the returns instead of relying on individual labor. Beyond ongoing income, the investment's value also comes from predictable cash flows, documented systems, trained management, and brand-driven demand. Well-managed franchise groups often sell for multiples of EBITDA, especially in sectors like food, fitness, childcare, and healthcare. If a franchise sells for much more than the original investment, it's acting as a true investment asset, rather than just a source of employment. Understanding whether a franchise is an investment or just a job makes a big difference in how you approach it. For investors, it's important to compare franchise returns not to a salary, but to other investment options like property, stocks, or private businesses. If you're buying a franchise that operates more like a job, you're taking on both the risk of running the business and the risk of losing your income at the same time. When thinking about the future, an investment franchise should have a clear way to exit, whereas a job franchise often doesn't offer that option. Also, true investments should free up your time over the long run, but jobs, whether franchised or not, tend to consume it. To evaluate a franchise well, you should ask about the owner's role after the first year, whether you'll be an operator, manager, or more of a strategic overseer, and make sure to get real data from current franchisees instead of relying on marketing materials. Another key point is understanding how much of the profit goes to royalties. High royalties can make sense if they help bring in customers, simplify operations, or boost profitability. But if they're too high, they can permanently limit your margins. When considering whether a franchise can be scaled, it's important to ask if the franchisor supports owning multiple units, whether territories are protected to avoid conflicts, and if the systems in place allow for effective delegation. If scaling is discouraged, there's a limit to how much wealth you can create. Equally important is understanding the exit market, who typically buys these franchises, the valuation multiples involved, and how easy it is to resell. Without a market of buyers, an asset isn't really an investment. To illustrate, take two examples. First, a single unit cafe owner who works long hours, earns a modest income, and can't step away without hiring expensive management, making the business hard to sell and essentially turning ownership into just a job with financial risk. Second, a franchisee who owns 8 fitness studios, employs area managers, focuses on key business metrics, and eventually sells the portfolio for a substantial sum. This reflects a real investment with the potential for significant financial returns. These examples highlight how scale and exit strategy define whether franchising is a job or an investment. A common path for franchise owners is to start by running the day-to-day operations themselves, like in the case of a childcare franchise. Over time, they develop systems, hire managers, and gradually step back from daily involvement, turning what started as a job into an investment through careful planning. Buying a franchise has clear advantages, such as lower failure rates compared to startups, recognized brands, operational support, faster cash flow, and easier access to financing. This makes franchising a structured way for many people to enter business ownership. However, there are downsides, including ongoing royalties that cut into profits, limited freedom to innovate, reliance on the franchisor's decisions, exposure to brand risks, and the possibility of paying a premium for perceived security. In general, franchises tend to reward discipline over creativity. Ultimately, buying a franchise is neither purely a job nor inherently an investment. It depends on how you manage it. Running a single unit and depending on your own labor is a job with support. But by building strong systems, scaling to multiple units, and stepping away from daily tasks, you can transform a franchise into a valuable investment asset. If you found this video useful, there's plenty of more business and finance videos on the channel that you'll enjoy watching and get great practical value from. In the meantime, thanks for watching.